All right, today we're going to do something a little different. We're going to tear down an analyst report for a company called Control Print Ltd. You ever wonder how they come up with those buy or sell ratings? Well, we're going to follow the trail of clues they left behind, from the raw numbers all the way to their final verdict. Let's get right into it.
Okay, let's just start with the headline number, the one that makes you stop and look twice. The report is flagging a potential upside of over 60%. Now that's a huge number, right? A claim that big? Well, it needs some serious backup. So let's figure out the why.
And that's really the core question we're trying to answer today. You've got a stock trading for about 750 rupees, but this report is saying, hold on, we think it's actually worth almost 1,200. How on earth do you bridge that gap? We're basically going to play detective here, following their logic step by step to see how they built this case.
All right, first things first. Before you can even think about where a company is going, you've got to know where it stands right now. Think of it like a doctor's checkup. We're looking at the company's vital signs to see if it's fundamentally healthy and stable today.
So the first vital sign is something called return on equity, or ROE. It's sitting at a pretty impressive 22.7%. What that really means is, for every rupee the shareholders have put in, how much profit is the company spitting out? And let me tell you, anything over 22% is really strong, especially for a manufacturer. It's a big sign that management is incredibly good at using its money to make more money.
Next up, the famous PE ratio, price to earnings. It's about 11.8. This is basically how much you're paying for each rupee of profit the company makes. But here's the key part from the report. That number is considered low compared to other companies in the same business. And for an analyst, that's like finding the first clue at a crime scene. It's a big flashing sign that says, hey, maybe this thing is undervalued.
Okay, now this next one really tells you about the company's foundation. The debt-to-equity ratio is just 0.02. I mean, wow. To put it simply, this company has almost no debt. It's running on its own money, not the bank's. For an analyst, this is beautiful. It screams low risk and rock-solid balance sheet.
So, let's just recap what we've found so far. We've got a low PE ratio, which hints at it being cheap, a super high return on equity, which means it's efficient, and it's basically debt-free, making it incredibly safe. The report also mentions a reasonable price-to-book ratio. Bottom line, the initial health check comes back with flying colors. The company looks fundamentally solid.
Okay, so the foundation is solid. That's great. But you don't invest in a company for what it did yesterday, right? You invest for what it's going to do tomorrow. So now we're shifting gears. Let's move on from its current health and start looking at its future, its growth potential.
And to do that, to look into the future, we need a new tool. The report brings out something called the PEG ratio. It's a pretty smart metric, actually. It takes that PE ratio we just talked about and adds a new layer, growth. It asks, is this company cheap relative to how fast it's growing? And the general rule of thumb is, if you see a PEG ratio under 1, that's a good sign.
And wouldn't you know it, the report's estimate for Control Print's PEG ratio is 0.8. Since that's less than 1, here's what the analyst is thinking. This stock isn't just cheap today. It looks cheap even when you factor in how fast we expect it to grow in the future. It's another piece of the undervalued puzzle. Here's another one. Free cash flow yield at about 6.9%. Forget accounting profits for a second. This is about real, hard cash. Think of it like the dividend a company could pay you if it wanted to. A yield close to 7% is super healthy. It tells the analyst this company isn't just making profit on paper. It's a genuine cash-generating machine.
Okay, so we've established two things. The company looks healthy now, and it has some good signs for future growth. But that's still a long way from a specific price target of almost 1,200 rupees. How do you get to an actual number? Well, that brings us to the main event, the core of this whole report, something called a discounted cash flow analysis, the DCF.
Now, I know discounted cash flow sounds super complicated, but the core idea is pretty straightforward. You basically do three things. First, you try to predict all the cash the company is going to make over the next several years. Second, and this is the key, you pull all that future money back to today's value because, $100 in 10 years isn't worth $100 today. Finally, you just add up all that present day value to get what the whole company is worth and divide it by the number of shares to get a price.
So, after all that number crunching, forecasting the future, discounting it back to the present, this is what the analyst came up with. Bam! On the left, you've got the market price today, around 750, but on the right, that's their DCF fair value, almost 1,200 rupees. And right there, in that gap between those two bars, that is the 60+% upside we talked about at the very beginning. But hold on, a valuation model is not a crystal ball, right? It's just a set of assumptions. Any good analysis has to be balanced. It can't just be about the good stuff. You absolutely have to look at what could go wrong. So let's flip the coin and look at the risks versus the rewards that the report lays out.
So on the plus side, the report loves the growth in their consumables business. That's the stuff customers have to buy over and over. They also see potential in smart acquisitions, especially since the company has almost no debt to hold it back. But there's always a but, isn't there? The risks are real. A bad economy could sink demand. New competitors could show up. A big acquisition could go sideways. And on top of all that, it's a smaller company, and smaller stocks can be a much bumpier ride.
So to deal with all that uncertainty, analysts don't just have one answer. They create a few different versions of the future. Their main one, the base case, is that 1,200 rupees target we've been talking about. But then they'll run a bull case. If everything goes perfectly, they think it could be worth over 2,000. And of course, there's the bear case. If things go badly, the value is right back down around today's price, near 712. So we've looked at the health check. We've looked at the growth signals, we've seen the big DCF calculation, and we've weighed the risks and rewards.
After all of that, what's the final verdict? Where does the analyst land? Let's bring it all together for the final conclusion.
And there it is. No ambiguity, no beating around the bush. The final recommendation is a buy. And the reason is stated right there in black and white: undervalued. After all their work, they've concluded that the stock is selling for less than what they believe it's truly worth.
And I think this is important. They don't just give one magic number. They give a range for what they think is fair value, somewhere between 1,000 and 1,400 rupees. That just shows you that this isn't an exact science. There's always a margin of error. But here's the kicker. Even the absolute bottom of their range is way higher than where the stock is trading today. So let's just do a lightning round recap of the whole case. It all starts with a strong, efficient company. It's got a fortress balance sheet because it's nearly debt-free. The analyst believes it's undervalued based on both what it earns now and what it's going to earn in the future. And when you put all those clues together, you get their big conclusion: a potential 60% plus upside.
And there you have it. That's how an analyst takes a company, breaks it down, and builds a case piece by piece, from a simple health check all the way to a final price target. They've laid out their evidence and their logic. So I'll leave you with this question. Now that you've followed their trail of breadcrumbs, what's the very next clue you would want to investigate to form your own opinion?